Real Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Well, happy weekend to you. This is The Real Money Pros. We are back after a 7-day hiatus, which is every week. We're lucky and fortunate enough to broadcast live here every Saturday. Well, for those of you are picking us up live. And the beauty of that is you can interact with us. Phone lines are open. We've been having some great calls coming through over the past week. Lots of things that are top of mind for investors. Apparently, Social Security is a big topic that a lot of people like to get some information on. So if you have questions on Social Security, retirement, market activity this week, I'm Jeremiah Bates, joined with Nick Daniels. We are fiduciary advisors here at your service. You want to talk about estate planning. You want to talk about proper tax planning and some strategies that are that certainly should be top of mind as we head into the end of the year. Remember, usually the tax planning that moves the needle the most, you got to do it in that calendar year, even though you have up until April 15th of the next calendar year. And obviously, if you file extensions, you get even longer. A lot of times the strategies that are there, you're too late, meaning you had to do it in the actual calendar year of where you're receiving income and where you're going to make those tax efficient moves. So we got a little bit of a checklist, some things that we're certainly covering with clients that here we work directly within our office, and maybe these are applicable to you. But again, give us a call. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Wild week on Wall Street. We've actually seen some volatility, which I pointed out last week is normal. When you're looking at the S&P 500 and you go back, you can go back a very long time. If the average pullback, I guess volatility you can say for the S&P 500 is you can expect, I think it was about 26 or 27 times within an average market year where you will see a pullback in a day of 1% or more. So again, everyone wants to call like this time is different, Nick, but I would argue that, hey, this is kind of the price of admission. At some point, you're gonna run into some volatility, and if you want that reward, you got to be willing to take some level of risk, and we're seeing it.
Yeah. Now, I want to reframe what you just said. You said 26 to 27 times within a calendar year, you're going to see a 1% or greater pullback on the S&P 500. Mm-hmm. In other words, think about this. That's every other week.
Yeah.
Every other week. So it shouldn't come as a surprise when we have this volatility. Does it give the talking heads on the news, does it give you and I something to talk about on the weekends? Yeah, absolutely. But for the investor who's just, every single month you're dollar cost averaging, you're contributing to your 401k every single paycheck, or, maybe now you're retired, you've got your bucket strategy lined up, and you're letting your investments do what they're supposed to do. You shouldn't be caught off guard that every other week you're seeing a movement of 1% or greater to the negative, but then the following week you're probably catching it back up.
Yeah. Yeah, no. And that's one of the things that you look at, where if you look at the timeline in a year, generally speaking, unless you look back on this average, because when you do a zoomed in scope of the market, like just that graph, you see way more up and downs. And if you zoom out, you just see that steady eddy growth trend. And the reality is that the market is up more for a length of time more than it's down for that same length of time. So again, it's just perspective when it comes to these types of movements in the market. Now, I will say this. We've been on an incredible bull run over the past few years, and bull run just means that the market's been outperforming expectations. There's a lot of market predictions out there, some pundits, where some notable ones too, that are calling for recession year over year over year, and just hasn't come to fruition. So meaning, if this volatility that you could argue we've seen a lack of over the past few years is making you questioning things a little bit, making it a little bit uneasy, you have a great opportunity. We're not too far off all-time highs to kind of recalibrate to make sure that your investments are aligned with your desired outcome, meaning have you taken some cream off the top of these great market years and maybe fortified your your short-term bucket of money. I mean, when it comes to time-based investing, and you've heard us talk about these buckets before, your short-term, your income, your long-term bucket should have been doing really well. So always look at, is your money serving you in a way that is giving you peace? Is it giving you a quality of life impact? And I would argue, I mean, at least conversations that I'm having with clients right now, it's how can we translate these great gains that we've seen into either fortifying liquidity, generating more income, meaning how can we turn this into a tangible target that is a part of your desired outcome? And for a lot of my clients, it's been pretty fun because about 4 or 5 years ago, our initial planning projections, it's great. Like we were able to handle things from a cash flow standpoint, but it's like I told them going into these, like if we see great market years, this gives us the opportunity to kind of recalibrate things to maybe you want to buy a motorhome, which certainly wasn't in the calculus when we started 5 years ago, but now it is. So that's the beauty of retirement planning, financial planning. It's not a line drawn in concrete. It is a line drawn in the sand. So again, phone lines are open, 979-59-MONEY. That is 979-596-6639. We're going to go to the phones right now. We have Gabby calling out of California. Gabby, what can we do for you?
It's actually Debbie.
Oh, Debbie. Oh, sorry, Debbie. Well, Debbie, what can we do for you?
So my husband just received a large gift from his employer, $50,000. I mean, it's large stuff. And I also received a $10,000 work bonus this year, which we have made some tax adjustments to compensate for. But I was told we can't put all $50,000 in my husband's IRA, and I don't know what to do with it.
Oh, it's well, I would say, yeah, you're correct. You can't dump all $50,000 into your husband's IRA. We've got contribution limits on IRAs on an annual basis. So if your husband's if he's over 50, I believe that limit's $8,000 is the most that he can put in within the calendar year. I mean, so that would only account for 8,000 of the 50 that he's been gifted. I think my question to you, Debbie, would be like, what are your short-term, mid-term, and long-term goals? Like what are you and your husband trying to do that you could take this $50,000 to actually maximize it for the purposes that you guys have in mind?
Well, we have virtually no retirement. I have a little bit with my employer, but so we're trying to I'm 58 and he's 61. And I mean, assuming we'll both be alive, we'll be working till 70. So we're trying to maximize out our retirement that make up for lost time. So that's a primary. And then secondly, we want to put like 20 grand into our home, into redoing certain portions of our home.
No, it's great. I mean, hard to argue against the mindset and the fact that, you have a realistic outlook of maybe we haven't been delaying savings at an accelerated rate during like previous years. So now that you're getting these windfalls, like what is the best approach? And I love the fact that you have taxes top of mind. So in your case, Debbie, you getting that extra $10,000 bonus, that's going to be taken into the calculus as far as income received. But let's dive into this $50,000. So just to be clear, this $50,000, is it truly a gift, or is it going to be earmarked as a bonus from the employer? Is this truly a gift which would mean there's no taxable implications with it?
It's truly a gift. My husband confirmed that with his employer. He did get the original. He has the check in hand, and the gal who actually processed the check wrote bonus on it, but he's going to have it redone. Because he asked the employer, he said, is it a gift or is it taxable in any way? And his employer said, no, we're shutting down the business. It's not taxable at all. It's just a gift.
Well, okay.
So he's going to get that reprocessed.
And that's an important thing to note. So now the question becomes, and Debbie, you nailed it, of, we're looking at traditional IRAs or maybe ways that we can bring down our income. Let me ask you this. If you were looking at your 2024 tax return, what was your taxable income for you and your spouse?
I know our adjusted gross was like 169.
Okay, so 169 on the gross side. Obviously, if you look at some standard deductions, your actual taxable income might actually fall around the 130, 120. And if we're looking at this and the fact of the marginal tax brackets that we're looking at, taxes aren't a big headwind. The best way to put it, because if we're looking at our marginal tax brackets for 2025, you are
just dipping into just dipping into the 24%.
Just dipping in the 20. Yeah, just dipping into the actual 22 because the top of the 22% matches out 206.
Right.
So that being said, I would argue that looking at fortifying your Roth IRAs should maybe take more precedent than traditional IRAs. Now, you're certainly below the income limit, so you can do a max deduction for both you and your husband, which to Nick's point is $8,000 per person. So that's $16,000. So let's imagine a scenario where you max fund these Roth IRAs this year. You invest them in the growth bucket, and you mentioned that you could be potentially working until 70, maybe, because we'd want to take into consideration Social Security and other cash flow sources. But if you let that money grow for over a decade inside of the Roth, those proceeds, when you withdraw them, are completely tax-free. Debbie, if you have some time, stay on the line. We got some more questions to make sure that we can properly guide you on that money that you receive. Stay with us.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deirdre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
And now, back to the Real Money Pros.
And we are back. This is the Real Money Pros. Jeremiah Bates joined with Nick Daniels, fiduciary financial advisors, here for you. We are live. Phone lines are open. You have a question, send it our way. 979-59-MONEY. That is 979-596-6639. You can visit our website. Use the Ask the Experts feature. Use the chat feature if you don't want to call into the program. Use the chat feature if you want us to answer your question live on air. We certainly will. You can catch our live stream via therealmoneypros.com through all the various social media platforms that are out there. I don't know all of them off the top of my head and which ones we're on and which ones we're doing the live stream on, but we're going to continue to expand that reach, of course. Now, we're going to go back to the phones. We have Debbie calling out of California. And just to summarize Debbie's question, she's receiving a bonus from her employer. Husband received a relatively large gift that does not appear that's going to be earmarked as taxable, which means it's no tax implications for the person who receives the gift, about $50,000, and we're looking at ways to be efficient. Debbie, you mentioned that you might be on the trajectory to where you might be working till age 70. And even though that may be from the case from the outside looking in, Nick and I were talking during the break, and it's like, let's kind of look at this from the whole, like the holistic picture. Because obviously that $50,000, we can look at that on its own, like it's on its own island, and say, okay, well, you could do this, could do that, but we're going to zoom out a little bit and kind of get a better picture of where things are, where the trajectory is from the retirement planning. Debbie, do you have any debt, like a mortgage, any significant debt?
We have a mortgage, and then we have a car loan.
Okay. Give us an idea of the mortgage, meaning the interest rate, the balance on it. Do you have an objective to pay that thing off before you retire?
The interest rates, we got it at 2 3/4, and right now I think it's at like 350, which is what we bought the house for 20 years ago. We've taken money out to like redo the kitchen and the windows and the popcorn ceiling and the bathroom. We refied a couple times.
Yeah, no, that's great. I mean, so now if we're looking at the best approach of the money, sounds like, do you want to earmark any of that to any more future home upgrades? Like, meaning it doesn't sound like you and your husband have any intention to leave this property, correct?
I mean, as long as we're both gainfully employed, probably not. And we have a daughter who lives out here in college, and so we'd like to leave California, but I don't think that's going to happen.
Well, hey, California, I will say, beautiful weather out there, so it's there's no solutions, just trade-offs, right? Where, hey, California's expensive, you got the state taxes, all of that, but I certainly see your approach. So, Debbie, in this case, does your husband's employer offer any type of employer retirement plan? And the same thing with you, Debbie. Does your employer offer like a 401k or deferred savings in that regard?
Yeah, I have a 503 whatever. It's a nonprofit employer.
Okay.
So whatever that is, I don't know, or 403.
Probably
or,
a
I don't know. I don't know what that
403B generally.
Yeah.
That's yep.
Yeah, 403B. But my husband, the reason he got this large, not bonus gift, was because he's worked for this employer for 23 years, and there's been no retirement plan. And now the employer has sold the business, and so my husband's still going to be employed, but by the new owner. So this $50,000 was kind of his way of thanking him for a job for the last 23 years. But no, he has no retirement with them.
So I like the approach. I mean, I certainly think the idea of setting up Roth IRAs, that would contribute roughly $16,000 of that $50,000 to allow for you to make a 2025 tax year contribution. Obviously, the approach would be earmarking that money for your future self. That remaining leftover balance, you could certainly look at these next few months before we get to the end of the year, maybe increasing your 403B contributions, Debbie, because remember, those you can only do through payroll. So meaning if you make that decision, you want to do it relatively quick because we're up against the end of the year. So maybe only a few more pay periods to try to like really ring that chamois to get as much as you can to the employer plan. And then also, looking at the liquidity side of things, there could be something to be said about maybe holding some of that money back to make sure that you have dollars at arm's length to touch on the things that you want to do in the short term.
And one other thing to consider as we're talking through this, Debbie, is that depending upon the payoff on the auto loan that you mentioned and how good of condition that vehicle is, if you plan on still hanging on to that vehicle for quite some time, if you could pay that vehicle off, eliminate that monthly note, but then in calendar year 2026, what you were making in monthly payments on that vehicle, pay yourself into those newly established Roth IRAs. So then you're still taking dollars that were already allocated for something on a monthly basis, but now instead of allocating them to reducing debt, you're allocating thing dollars to investing in your future selves.
Yeah. Well, and Debbie, another thing too is that gift. remember, tax-free, meaning you're not getting taxed on that money. So if you're able to earmark some of that money going into a Roth that can grow tax-deferred and then be utilized tax-free when you actually distribute the money out, incredibly efficient. Debbie, what I would say is, yes, we can look at this money on its own on an island. I would say let's look at this from the lens of your future selves, 65, 70. How does this all coordinate with all the moving parts that you have? Have you ever sat down with an advisor and kind of looked at high level the trajectory that you're on? Obviously, you have the assumption that you're working until 70, but has someone, as far as in the advisor capacity, given you that projection or that trajectory?
I mean, kind of, but when I talk with them, I feel really stupid, and they say stuff, and I'm like, I have no idea what you're talking about. I mean, I have my master's degree, but I don't really understand this stuff. It doesn't, my brain doesn't get it.
Well, I'll be the first one to admit our industry does a great job of making things sound confusing and making it seem that you need to work with an advisor because we're some type of secret decoder pin, and that puts you in a disadvantage. Our approach is pretty simple. We want you to understand it, meaning having the education so you know why you're doing it and what the outcome is going to be of those decisions that you make. But it's got to be holistic. It's got to be coordinated all together so you and your husband understand what you're doing with that money. So then once you understand it, you can stick to the strategy. Most investors, where they get tripped up is where if they don't understand it, they let those emotions get into the mix, and then they could put their future selves as a disadvantage. So, Debbie, we certainly appreciate the call. Please get something set up with us. We can sit down, meet with you and your husband. We can do an introductory call. I mean, whatever we got to do, but we want to make sure that you feel good. You understand that it's not just an assumption that you have to work till 70, meaning you either know that for sure that is the trajectory that you're on to hit those retirement projections, or you might be pleasantly surprised to understand that is not in fact the case. You could retire earlier, meaning what's the appropriate approach with filing for Social Security, and then as you have these working years, how you should defer net savings and how this looks into the grand scheme of things. So, Debbie, appreciate the call. Reach out to us via the website, use the Ask the Experts feature, give us your information, and we will get something coordinated with you sooner rather than later. But Nick, it's a great point. I mean, you run into these issues where you get some windfalls, you feel like you're behind the 8 ball as far as retirement, but you could be surprised how just a couple of years of proper savings, proper tax management, proper contributions into the right accounts, it could change the trajectory completely. I've seen it, especially over the past 5 years.
Yeah, it's really amazing. So meet with a competent advisor who's going to give you that comprehensive view.
This is the Real Money Pros. We'll be right back.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
And we're back. This is the Real Money Pros. Again, Jeremiah Bates joined with Nick Daniels, fiduciary advisors here at your service. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Visit our website, therealmoneypros.com. Use the Ask the Experts feature. Use the live chat feature. If you feel like you can't call in and you want to send us a message via the live chat, send it our way. We will answer your question because it's good for the cause. It's good for the community. If you have a question, I can almost guarantee that there's a listener out there that has that same question. So keep them coming through. You want to talk about Social Security strategies. You want to talk about Roth conversion strategies. You want to talk about how the market is behaving. And you could argue that it's been a little misbehaved over the past week, maybe over the past 2 weeks. We see some volatility. We've seen some interesting dynamics in the market as we head into the end of the year. And really, if you look at the market as a whole so far for 2025, there's been some interesting movements when you look at the effects of tariffs. You look at the Federal Reserve and where interest rates are going to go. You're going to look at the AI, the technology narrative, and now maybe some concerns that things are a little bit too frothy. Maybe we have some over-concentration of just a few companies that have been driving all the gains and a lack of participation from the remaining companies, maybe say within the S&P 500 or the NASDAQ or the Dow Jones. And we've also seen outperformance in international investments, which I don't think many people were anticipating going into this calendar year. So I really appreciate Debbie's call from the last segment where she brought up of like, yeah, I met with an advisor, but she's like, I have a master's degree and they make me feel stupid. Okay, that is not the objective here. If you don't feel educated or how maybe what you could view as a complex strategy is simplified, then we are not doing our job. So all that to be said, to bring us into the next guest that we have, Mr. Eric Sterner, who is the Chief Investment Officer of our firm that we're associated with, Tree City Advisors of Apollon. We have Eric Sterner, who is, again, the CIO with Apollon Wealth Management. Eric, appreciate you taking time on your Saturday. We've been meaning to do this, so I'm glad we were able to line up the schedules. And I think it's very timely that we get your professional insight, your professional take on really what has been kind of an interesting last couple of weeks that have maybe changed some thoughts for some investors of the trajectory that we've been on for 2025. So I got a number of questions and routes that I want to take with you, but maybe just from the get-go, give us your thoughts on what really is probably top of mind of investors. And I would argue that's maybe concerns about what is overvaluation or concentration with certain companies, and is this sustainable when you talk about NVIDIA or your companies that are well positioned with that AI narrative, and also the Federal Reserve and with interest rates and how the greater economic picture when you talk about employment and all of these factors. How does that go into your thoughts on how you're viewing the market? So I know I threw a lot of questions out there for you, Eric, but hopefully that gives you a good jumping off point.
Oh yeah, absolutely. Well, thanks for having me. It's a pleasure to be here, and it's been quite an interesting year. I mean, we saw so much volatility back in the spring after Liberation Day, but since then the market once again has been on a tear, just like the last 2 years, and I think this pullback over the past few weeks is healthy, just because the market's just been on fire. It was up over 20% in 2023, 2024, and it was off again another strong year this year. So I think the pullback is healthy, but overall I remain very bullish. I mean, we're coming off another outstanding earnings season where we've seen 4 straight quarters of double-digit earnings growth. The net profit margin, S&P 500 companies at an aggregate level, is the highest it's been in since 2009. It's been 7 straight quarters of net profit margins increasing, and it's also had the highest revenue growth rate in 3 years. So just the earnings picture alone, sure, there are plenty of risks in the markets and things that have some investors concerned. There are always risks. But when you see earnings like that, it's hard not to be bullish. And I think what we're going to see and what we have seen kind of come and go over the past few years is we're starting to see some of that market rotation because, as far as communication services, technology, I mean, yes, those valuations are a bit frothy. I mean, you look at maybe the top 10 stocks, their PE ratios are in the 30 range. But, I mean, the earnings are just incredible. I mean, I think they're justifying those earnings. They're priced to perfection, but they're living up to that. So I think at some point, the earnings maybe, there may be some slippage there. So I think it's just important for investors to remain diversified and look at other areas of the market. But I think it's a great story, and I think we're going to continue to see some, great returns going into next year.
Eric, this is Nick here. Do you think is there any concern given our current market environment where it's only the large cap or mega large cap stocks that are able to continue to meet or exceed these quarterly earnings compared to, say, mid caps or small caps, more of like, like the mom and pop America? Is there any concern in the division of those smaller or mid-cap companies able to perform and keep up compared to the large cap? And then kind of like a follow-up question, because we're sort of seeing that with like consumer spending in GDP, where it seems like it's the higher net worth people that have the ability to do that discretionary spending, kind of keeping the GDP going versus the middle class or lower class.
Yeah, I do think certainly mid cap and small cap companies they've seemed to at different points over the past 18, 24 months have had a rally, then for that rally to fizzle out, and you really typically see that rally kick off when there's expectations of more Fed rate cuts, because those sectors are very interest rate sensitive because they have a lot of floating rate debt compared to large cap companies. They're also very sensitive to the economy, and now there are some concerns about the labor market right now. So I think that's why it kind of those rallies start and fizzle out. I think it's always important to have those allocations of mid and small cap in portfolios, because when they take off, they're going to take off fast for a couple of reasons. I think their valuations are much more attractive, especially mid caps right now. And the Fed is in the easing schedule. How fast they go in cutting rates, is debatable, and only time will tell. But as the interest rates come down, that's only going to be tailwinds for those asset classes. I also think, tariffs they have less negotiating power, so that's kind of held them back a bit. And the uncertainty with the trade policies coming out of the White House administration. But again, a lot of those uncertainties are starting to go away. I think there's a clearer picture of what lies ahead for companies so they can plan ahead. And of course, really, what it's all about is earnings. And right now, projected earnings going into next year, it's projected that small and mid-cap earnings growth rates are going to exceed large caps. So that's another reason why I think we'll see some stronger returns there. And then the final reason why I really like those asset classes is they're very domestic based. And between all the initiatives with the One Big Beautiful Bill, as well as more initiatives for domestic manufacturers, I think that's really going to set up for a good story for mid and small cap companies. I know some investors have kind of grown impatient with that asset class. But remember, a year ago, many investors were impatient with international, and for those investors that kept that allocation in their portfolios, they're very happy right now. So I think it's always, that's diversification in my mind. Is you always have something in your portfolio that you don't love at the moment because you just don't know when that big run is going to come. But I think there's a lot of tailwinds setting up for mid and small cap companies, and also another big tailwind company is all the deregulation policies coming. And small and mid-cap companies typically have a higher percentage of their overall equity allocated to regulatory costs. So that's going to be another tailwind there. So while I like those asset classes, the other item you mentioned is consumer spending and just the bifurcation there. And that's something that I think is concerning. You look at the top 10% of earners in the U.S. right now account for nearly half of consumer spending. 30 years ago, that segment, the top 10%, accounted for about a third of spending. So we're really seeing that stronger bifurcation there. And I think some of that, a lot of that is just the wealth effect, because the market has been on such a run. Home values have been increasing over the past several years, and the top 10% of earners have more exposure to the housing market, more exposure to the stock market. So they are continuing to spend even with a higher cost because their net worth is increasing. While for the lower end consumer, we know the cost of living has increased nearly 25% since the pandemic. And I think, many consumers have the wrong expectations that they think the cost of living is going to come back down to where it was 5 years ago. And that's not going to be the case. It's just a matter of is slowing down inflation and slowing down the rise of those costs. That's what we're starting to see. Clearly inflation right now is about 3%, and the Fed wants to get that down to 2%. But the cost of living is really eating into those lower earners.
It certainly is. We got to take a break. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
And we're back to the Real Money Pros.
And we're back. This is the Real Money Pros. Again, interact with us. Visit our website, therealmoneypros.com. Use the live chat feature. Use the Ask the Experts feature. If you have questions for Chief Investment Officer of Apollon Wealth Management, Eric Sterner, who's joining us today, send them our way. Of course, we're live. This is the first hour of our 2-hour live program. If you want to call 979-59-MONEY. That is 979-596-6639. We're going to go back to Eric. Eric, again, appreciate you taking the time Saturday to talk markets. Obviously, this is what you do on a day-to-day basis, and we can feel the enthusiasm when we're talking about things, which is great. You've been in, I guess you could say, in a capacity as far as working with investments and managing portfolios for a relatively long period of time. I'm always curious for these industry veterans that maybe have decades under their belt, where you could argue that in this place that we're in right now, as far as the economy and these businesses that are leading, we're talking multi-trillion-dollar companies where it was almost impossible to fathom that maybe 15 or 20 years ago. And these companies maybe didn't even exist at that point in time. And now these are industry leaders. Maybe you could even argue blue chip companies that are not necessarily replacing, but just a changing dynamic. So all that being said, I would just be curious to get your take on how do you approach and lean on your younger self when, the historical context of this, and can you even use that in your toolbox, so to speak, of where you're viewing things, because the economy now is just so starkly different than where it was?
Yeah, I mean, it's certainly changed, and you look at the top 10 companies, decades ago and versus now, and before the top 10 companies, they were producing products that were more tangible, and now we see it's the technology that's really leading the way. And that's just the way of the world. I think we're going to continue to see that, with technology being one of the leaders. I mean, while there's been so much talk about the innovation of AI, and I do firmly believe we're very much in the early innings right now, because we still haven't, there's every sector in this economy is going to benefit from AI through reduced costs and better efficiency. What also really excites me is just really starting to catch on now is just the healthcare and weight loss drugs. And I mean, we're starting to see healthcare finally break out of that slump. And when we talk about that market rotation, I mean, it's the leading sector for the past month and quarter to date with these weight loss drugs that are expected to be a $150 billion industry by 2030. So I think, typically you see healthcare kind of struggle under a new White House administration as investors try to figure out policies coming out of the new administration. But now we're starting to see that run as the drug shortage that kind of caused that healthcare and biotech to be held back earlier this year. And also the big announcement just a few weeks ago from the Oval Office, how the lower drug prices for these weight loss drugs, and now it's going to be broader coverage with Medicare or Medicaid making it available to more investors. So I'm really excited about the future with all this innovation. I think that's why when people question whether U.S. exceptionalism is dead, I laugh. Because while I think it's important to have exposure to other parts of international economies and emerging markets, I think we're going to continue to see the strongest returns come out of the U.S. For the foreseeable future.
Hard to argue with that call, Mr. Sterner. I don't disagree. And Nick, I don't want to take away all the questions, but something I have top of mind and something I've been paying attention this week, and this interesting stat that I heard where over the past 6 months, we've seen about a 35% increase in retail investors trading on margin. So really where it got my mind going is we're talking about good diversification, meaning investment principles that have withstood the test of time. But I think when you look at a lot of investors where they kind of get tripped up, it's you have these good companies that are reporting earnings and, the demand is there and all that, but, the stock's getting beat up or it's getting wiped out in maybe a broader base sell-off. And it just got me to think where these comments that are talking about the frothiness in the market, can you speak to the plumbing of the market, meaning, you have the fundamental side of things where you have a good company, but you also have the speculation side of the market, which certainly can affect things in the short terms where you have this higher approach toward taking on leverage, trading on margin, and even companies taking this approach. So does that concern you at all? Is that something that you have any insight on that can kind of help listeners have a better understanding of, okay, obviously you have the underlying investment looking at it through the business, but there's also this whole plumbing side of the market which can affect things short term.
Yeah, no, I agree because while I'm very bullish for as you've heard from my last few comments, I do think that the risk level that some of these retail investors are taking is too high. I mean, when you see, I don't have the statistic in front of me, but there's been so many new fund launches this year, and there's been several hundred of these leveraged funds coming out, and I think those really are bad news because investors are, really just, putting too much risk in the portfolios that they can't really afford. And what scares me too is with these leveraged or even inverse funds is that they're designed to be held for one day. And that's all they're supposed to do. And if you look at their prospectus, it's in big bold letters. But many investors are putting a lot of money in these leveraged funds because they want to get rich quick, and who doesn't? But you have to remain disciplined in order to be successful in the market. And with these leveraged funds, if you hold them for a longer time period, just due to the compounding of they're trying to match the daily performance of the benchmark. There's differences. And there's differences that compound over time. So you might have a fund that's 2 times or supposed to be 2 times a certain index or stock. And while the stock may be up over 6 months, you could actually lose money due to that compounding differences because of all the derivatives use of those leveraged funds. So I really strongly discourage investors from using those leveraged funds. Certainly another speculative area of the market that we've seen extreme volatility is within the cryptocurrency space. Now, I'm not anti-cryptocurrency by any means, but I think investors should, look at that volatility and remember that while it can go up very quickly, we've seen over the past few months it can go down very quickly too. So it's just something to be mindful of when investors, the allocation and what percentage of their portfolio they may be putting into those cryptocurrencies that have that higher volatility. I think blockchain is certainly here to stay, but now we're starting to see stronger correlation with those cryptocurrencies with the NASDAQ 100. So it's really, I don't know, only time will tell if it's a true diversifier for portfolios, But that certainly hasn't been the case over the past few months.
Yeah, I think many individuals would lean on the whole cryptocurrency play as it's a non-correlated asset, meaning that it's not going to trend or track what the broader markets are doing, but arguably that hasn't been the case, and it's been going the opposite way, especially over the past few weeks. When you looked at, I don't know, let's just talk about Bitcoin. It was up over $126,000 a token, I think, early October.
Yeah.
And now here we are where I think it dropped below $80,000 a token. So I think it just comes down to know what you own and why you own it in the first place. And hopefully if you're looking at cryptocurrency as, exposure in your overall investments, that you understand that that's just a characteristic of that investment where, yeah, you could see a quick ascent to all-time highs, and you could I see interesting stat with Bitcoin. I think going back to 2010, there's been 8 times where we've seen pullbacks of 50% or more from its all-time highs. So just looking that on its own on an island, it's like you have to understand that there is an extreme level of volatility, and you just got to be prepared for that. And then if you're looking at the broader markets, yeah, I mean, you have the short-term speculation side of things, but you have the disciplined approach via diversification, taking advantage of opportunities that, Eric, I think you pretty much nailed it, has withstood the test of time. And in your experience, decades of experience, it's how investors are successful. We're up against, we got about 30 seconds here, Eric. Anything that you feel super optimistic about or anything keeping you up at night that you want to leave the listeners with?
Well, the biggest risk that I'm keeping my eye on is the labor market. Certainly we've seen some weakening there. Especially with smaller companies, 5 out of the last 6 months, we've seen companies with less than 50 employees shedding jobs. I think that is going to turn around next year, but it's something obviously the Fed is watching as they've lowered rates. But I think overall,
Eric, I hate to cut you off. I appreciate you. We're up against a hard out. It's Real Money Pros. We got the second hour coming up at the top. We'll be right back.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is brought to you by the quality sponsors heard within this broadcast.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. Ataraxis partners with businesses of all sizes and industries. Their mission? To reduce the stress and risk that comes with business owners trying to do it themselves. Visit ataraxispeo.com. Ataraxis, elevating businesses for the benefit of all. Apollon Wealth Management has helped me and my team change the way we conduct our advisory business. The result? We believe we are better equipped to provide the highest level of quality financial planning, investment management, and comprehensive financial advice than ever before. Apollon has been instrumental in our efforts to assist clients in achieving their distinctive financial objectives. If you're an advisor seeking to improve your client experience or an investor seeking to elevate your wealth management to a higher personal standard, contact us at The Real Money Pros. That's therealmoneypros.com. Imagine financial advice without a sales pitch to buy something. Imagine a long-term financial plan focused on your goals, not your investment professionals. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes and complicated financial issues from your past, empowering you with knowledge, lower fees, and confidence. We design simple, effective investment strategies, and we teach you how it can all work without clutter, confusion, or high costs. Welcome to Tree City Advisors of Apollon. This is the way we think of financial advisors should work for their clients. At Tree City Advisors of Apollon, we provide flat fee financial planning and training. We also offer full service asset-based investment management, and we employ do-it-yourself technologies. Visit treecityadvisors.com. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
Are you in the market to buy a house or just looking to refinance your current mortgage? For helping individuals and families achieve affordable home ownership, Academy Mortgage is a first choice. And when finding that perfect loan for the perfect home, you need a company that will treat you like family, not just another file. To help you navigate through today's ever-changing housing market, Academy Mortgage has zero down options available to you. That includes zero down with no mortgage insurance. We also offer medical professional loans and 2-1 rate buy-downs that help lower your monthly payment for the first several years of your loan. Origination, processing, underwriting, and closing and funding will all happen in-house. With over 34 years in the business, we know that buying a home is more than just a house. That's why it's important we protect our customers and safeguard their financial wellness for years to come. Visit us online at academymortgage.com today to start your journey to homeownership with Academy Mortgage. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
To offer valuable advice and earn clients' trust as an advisor, it's essential to always put their interests ahead of personal gain or the preferences of any particular company. Advisor Insurance Solutions is dedicated to delivering insurance solutions from an advisory perspective. They provide objective and unbiased insurance planning, making it an integral part of their comprehensive advisory process. If you're looking for insurance guidance that aligns with your financial goals, visit therealmoneypros.com. That's therealmoneypros.com.
Nobody protects you from mayhem like Allstate. I'm a speed bump. Did you hear what I said? I'm a speed bump. And if you have cut-rate car insurance, the cost to reattach your muffler could really be a bump in the road. So switch to Allstate, save money, and be better protected from mayhem, like me.
Based on coverage and limits selected, subject to terms, conditions, and availability. In most states, prices vary based on how you buy. Allstate Bar and Casualty Insurance Company and affiliates, Northbrook, Illinois.
Running out of gift ideas for your loved one? Send flowers with Flower Fix. And need to create joy in your living or workspace? With many working from home these days, create joy in your space with flowers. Flower Fix is a subscription-based flower delivery service perfect for birthdays, anniversaries, or any special occasion. We offer 2 subscription options to choose from, a text-based subscription or a traditional one. Enjoy these big, beautiful hand-designed bouquets that are delivered straight from our flower fields to your door. Log on now, www.flowerfix.com, to choose your flowers today. Have control over when you want flowers delivered. Weekly, bi-weekly, monthly? Get your flower fix at flowerfix.com. Use code FlowerFixPro to receive 20% off your first order. flowerfix.com.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
Healthcare expenses can be a burden, so why not make the most out of the money that we'd spend anyway? Take advantage of the most powerful tax advantage account title available to us, a health savings account, also known as an HSA. That's why you need Lively. Visit Lively right away. Open your HSA, roll other HSA money into that new plan, and then start saving. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO.
Hi, I'm Stephanie Gallegos with Price for Life. Do you have a life insurance policy that you'd like to sell? If you don't need the coverage anymore or would rather not keep making the premium payments, visit our website, priceforlife.com. Don't let your policy lapse when you can potentially get a cash payment for it. There are several reasons why a life settlement might be a great value to you. Perhaps your policy is too expensive, or you feel you no longer need the death benefit, or you may think you need to wait until death before your family can get the money from the insurance company. This is why you may want to consider a life settlement. Price for Life has excellent resources available along with a free evaluation process to help you understand the value of your policy and the options available to you. Price for Life's clients have received hundreds of thousands of dollars for their policy when they would have otherwise just let it lapse by stopping the premium payments. Get the compensation you deserve. Visit priceforlife.com today and fill out the case evaluation form to see if your policy qualifies. That's price, the number 4, life.com. Priceforlife.com.
Real Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Welcome back. This is the Real Money Pros, hour 2 of our 2-hour live program. The beauty of us being live is that you can call us and ask us questions. Jeremiah Bates joined in studio with Nick Daniels, Fiduciary Financial Advisors here at your service. You want to talk investing? Let's talk investing. You want to talk stock market? Let's talk stock market. We had our Chief Investment Officer with Apollon Wealth Management, Eric Sterner, last hour. If you missed any portions of that, visit therealmoneypros.com. You can access our podcast, our archived shows, our educational videos. It's all going to be there. But again, he gave some good insight. Clearly, the guy's bullish, right? I mean,
very bullish.
He obviously brought up some concerns that I think a lot of people have top of mind. Maybe some short-term frothiness in the market. You certainly have this speculative play that maybe people are trying to achieve some outsized returns via the leverage route, which could potentially trip you up. But the message that I took away is, hey, staying disciplined, staying diversified, and staying invested is the winning formula. And that may not sound sexy to a lot of people out there, but again, the people that have been successful as far as accumulating wealth, maintaining their wealth, that's generally the approach that they take. There's not some secret alternative investment or private investment that the ultra high net worth people are using to drive their gains. It's no, they have a plan, they set a strategy, and generally they stick to it, and that's what's going to work out for you. So we had a great call the last hour, Debbie, who said, hey, I asked her, have you met with an advisor who's, you have the assumption that you need to work till 70, but have you met with someone that's really like dove into everything of saying, okay, here's all your resources, here's the trajectory that you're on. Is that in fact the case? And she mentioned, she's like, yeah, but they made me feel, and clearly Debbie's not dumb. She mentioned, she's like, I have a master's degree. I'm very well versed in a lot of things, but when it comes to these financial topics, I can't understand them, and it kind of goes over my head, and it's like, oh, that's the last thing we want. And especially when you're in an advisor relationship, I would argue if you don't understand the strategies and they're not educating you along the way, it puts you in a tough spot, meaning because if you don't understand the strategy or have the education, then the likelihood of you following it or getting wrapped up in the emotional turmoil of the markets, I've seen as it's a much more likely outcome.
Yeah, to throw out a really old movie reference from Cool Hand Luke, if you've met with your financial advisor and you walk out of there and you don't understand the strategy, what we have here is a failure to communicate. And I see that all the time in the meetings that I have with my clients, or mainly I would say with prospective clients, new people that are coming our way. Maybe they have an advisor, maybe they've never met with an advisor, but whether the radio, the website, our social media streams are saying, hey, I think I want to speak to the people at Tree City Advisors of Apollon. I just need to know. I need to know. And I would say 9 times out of 10, people will come into the office, they're feeling, their words, behind the 8 ball with their retirement planning. They're feeling like they haven't done enough, they haven't worked hard enough, they haven't saved enough, they haven't planned well enough. They've just kind of been flying by the seat of their pants. 9 times out of 10, those people, it's the people that have actually had the right principles in place that are the ones coming into the office in the first place, right? And then I'm able to sit down with them, take these puzzle pieces that they bring to the table and say, okay, you tell me what you want the picture to look like. I'll take the puzzle pieces, and I can actually, usually 9 times out of 10, like I said, make those puzzle pieces work to create the picture that they were hoping to see. And it's just because we have some skills and a tool set at our disposal, Jeremiah, that allows us to take what they have brought to the table and make it work for them, right? Their job is not financial planning. Their job is fill in the blank.
Right.
Our job is the planning. Our job is the fitment of the puzzle pieces. And again, 9 times out of 10, after 60 minutes, 90 minutes of meeting with these people, their shoulders are not slumped anymore. Their countenance is brighter. Their demeanor is lighter because they realize, oh, I can do this oftentimes sooner rather than later. My favorite conversations are when at the end I can say to them, hey, do you understand that tomorrow or Monday morning when you're going into work, you're going into work by choice, not by force, because we've just solved your dilemma. We've figured out if you think that you're done cutting and are ready to cut the corporate cord, as you like to say all the time, man, you can do that. I love those conversations, and all it takes is sitting down with someone who's got a skill set that you don't have.
No, it's well said. I mean, that's the benefit of working with a competent advisor. So again, if you have questions, visit our website. Go to therealmoneypros.com. Use the chat feature. Use the Ask the Experts feature. Call us 979-59-MONEY. That is 979-596-6639. Okay, let's talk about, we're coming up the end of the year. Now, like we were talking about at the beginning of the program, is that generally speaking, if you want to make some movements that move the tax needle as far as keeping more money in your pocket, this is generally the time of year that you need to look at making those moves. If you have your tax counsel, especially if you're self-employed, now is a great time to meet with them or send them, hey, here's what I'm looking at for this year's net expenses. What are you seeing on the board? What am I missing? What questions should I be asking? And a prime example of this is I have a client, realtor, real estate agent. She's actually crushed it this year. I mean, I met with her, and she's like, well, I've actually been doing really well. I'm like, great. Previously, she's been doing SEP IRA contributions, meaning she can take a percentage of her net income and defer it into this pre-tax account, much like you can do with IRAs. The issue with that, though, is, we're diving into the nuance and trying to really make sure we're capitalizing on everything, is that SEP contribution is actually earmarked as a contribution from the employer. SEP stands for Simplified Employer Pension. So if you're talking about a pension, it means that is being funded by the employer. So sure, she's getting that pre-tax benefit that is flowing into this account, which reduces her taxable income. That's great, but we're missing something. And that's the qualified business income tax deduction, which is it's 20%. And there's some carve-outs and things, and obviously there's some phase-outs. So I'm painting with a broad brush here, but that's 20% savings that you're getting on your net business income. That's that QBI deduction. Well, we're missing maximizing that deduction because that SEP IRA is reducing because it's coming as an expense from the employer. So you're getting that pre-tax benefit, but it's actually reducing that net business income, which is reducing that qualified business income tax deduction. Let's just make a simple flip. Let's use an individual 401k. She's got no employees. That individual 401k is going to be funded by her as the employee. So she's likely going to get more money on a pre-tax basis going into the individual 401k. And she's going to get more savings because she's going to have a higher amount that's eligible for that QBI deduction. These are the things that we're talking about, meaning many times when you're working with a CPA or a tax preparer, you got to be the one that come up with these strategies and these ideas, which is great, but do you know them and do you know the right questions to ask? So Nick, let's talk about kind of going up at the end of the year, things that maybe you should have top of mind as far as efficiencies that you have to look at getting done before the end of the calendar year.
Yeah, first thing that comes to mind is your 401k contributions. Right? If you, let's say your goal is to max them out by the end of the year.
And assuming you're a W-2 employee working through an employer,
Correct.
Right?
Yep. Going through your payroll deductions into your 401k. You should be able to log in at whatever service provider, Empower, Fidelity, wherever that's held, and see what your year-to-date contributions are. And you have the opportunity then to log in, and you could either adjust up or down the percentage of your wages coming out of your check going into the 401k if you're wanting to get that last little bit maxed out. So if you're under 50, that's 22.5 this year. I think it's 23.5 next year.
Mm-hmm.
I hate how they change it every single year because I'll get it memorized and then I lose it. If you're over
23.5 for 25. So
23.5 for 2025. If you're over 50, again, you get that additional catch-up. And then for those that are between the ages of 60 and 63, remember, there's the super catch-up contribution. So instead of that $7,500 for those that are age 50 to 60, if you're 61, 62, or 63, you get an additional super catch-up contribution, which puts a total up to $11,250 above and beyond that $23,500. So you have this short window to make that adjustment to your contributions.
You do, but you should pay attention to it, because you also got to think that when you make that election, it may take one pay period for that to actually get updated. But if you're really trying to maximize the juice that you're getting out of that squeeze, the reality is when you're looking at a 401k that you are funding through payroll contributions, it's the only way you can add to it is through payroll contributions. So if you're looking at maybe some higher taxable income from your other spouse and you're like, hey, I got about a month where I can maybe send the entirety of my paycheck into these employer plans, that could be the right approach. Let's talk about HSAs if you have it through an employer and how you can fund it outside of payrolls. We'll be right back.
Make this year that you work smarter, not harder, with Ataraxis. As your strategic partner, Ataraxis becomes an extension of your business, taking the burden of HR, payroll, benefits, workers' compensation, compliance, and staffing off your plate. You'll have more time to focus on operating and growing your business. Let Ataraxis handle the details so you can focus on what matters most. Learn more at ataraxis.com. That's ATARAXIS.com.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
This open enrollment, start making meaningful progress towards your long-term financial goals. Did you know that a health savings account, or HSA, is the most tax-advantaged account in the U.S.? Contributions are tax deductible, which reduces your total taxable income. Withdrawals for eligible health expenses are also tax-free. And last, capital gains on investments are also tax-free. Did we also mention that it's free for individuals? Visit livelyme.com/pro today. That's livelyme.com/pro.
Now, back to the Real Money Pros.
Welcome back. This is the Real Money Pros. Again, interact with us. Visit our website, therealmoneypros.com. Use the live chat feature. We'll get that on air right away. We'll answer it. Use the Ask the Experts feature. Send it our way. You will get a response from one of the fiduciary advisors on our team. There's some questions that have come our way. We want to talk about 1031 exchanges, how those coordinate with Delaware statutory trusts. Bottom line is, if you have some highly appreciated property and you're no longer you no longer want to be beholden to the landlord side of things. You do have tax-efficient options that you can certainly use, and we've used them many times here in our office. Again, we're not selling you anything here. We're just trying to give you education. We're trying to take our experience of working with thousands and thousands of households and taking that opportunity to deliver that message over the radio. The only thing we ask of you is check out our sponsors. We're a sponsor-driven program. And then go to our website, realmoneypros.com, Ataraxis PEO, professional employer organization. If you are self-employed and you don't want to be burdened or bogged down with the time-consuming operation of HR, human resources, how to handle payroll, offer benefits, the proper disclosures that you have to put up in the break room, and how do you adhere to those state laws when it comes to employing people. Ataraxis can be a trusted partner that can take care of all of that, helping you focus on probably what you want to focus on, which is the endeavor that you're on in your business. We also have Apollon Wealth Management. Of course, they're partners of our firm, True City Advisors of Apollon. We had Eric Sterner, which is Apollon's Chief Investment Officer, on the program in the first hour. Of course, you can catch that via our podcast. And also, I'm sure we'll get some social media clips that our producer Alec will get out there, which will be great, and he does a great job. All right, Nick, I want to bring up a question. Or no, real quick, before we pivot to the question that we got through Ask the Experts, I want to talk about the 401k. Obviously, going up to the end of the year, if you feel that you still have room to be able to maybe max out that employer retirement plan, one thing you have to be mindful of is that it has to be done through payroll deferral. Meaning you can't write a check or do some ACH transfer to try to maximize that. We pretty much well covered that. There's a misconception with health savings accounts that I've ran into for a number of prospective clients that I've ran into, where they're under the assumption that it can only be funded through payroll deferrals if you're using an HSA that's offered through your employer. Not the case.
No, I mean, that HSA belongs to you. It's a little bit different than being a 401k that, administered by an entity, say Fidelity, Empower, but it's put together by the company, right? And so basically controlled by the company. Your HSA is yours. So if you need to make extra contributions to that in order to max that out and get those tax deferral dollars into that account that you need to for this calendar year, you can just simply write a check to that custodian and get it funded. The other thing I run into oftentimes, so if both individuals are covered by that plan and both individuals are 55 or over.
So let's dive into that a little bit. So it's 55 and older rule. So meaning if you have group coverage, meaning through let's imagine you're on an HSA, health savings account, eligible healthcare plan, you're covered by that healthcare plan and your spouse, and then you could add some kids in there, but meaning it's just you and an additional person, you now are eligible for a higher contribution limit into that HSA.
Right. So once you turn 55, as long as you turn 55 in that calendar year, you can do an additional $1,000 contribution for yourself. Now, where it gets interesting is if your spouse is covered under that plan, but you're the primary person on that plan, you're the primary name on that HSA, and your spouse is 55 or over, right? In order for them to get their $1,000 catch-up, they actually have to open up an HSA in their name to get that additional $1,000. It's a weird nuance, but it's a miss that I see and low-hanging fruit if you want an additional $1,000 tax deduction in that calendar year.
Yeah, and it kind of makes sense because I've dove into this. I'm actually doing this with a client right now where you have one of the spouses that actually set up the HSA, and they're stating with that HSA custodian, maybe it's a Lively, maybe it's a Health Equity, who knows the custodian that's holding the HSA. When you set that up on your own, you're going to put in your information. So that custodian's probably going to recognize, okay, here's this individual, Mr. Smith. He's got a group plan, so we already know his limits for an HSA contribution. Oh, we have his date of birth, so we see that he's over 55. So there's the max that they can put in there. It's not taking any part into the equation that you can do that extra $1,000 because you have the spouse who's over 55 as well. It's not asking you that question.
Correct.
So on its own, when you open up that single HSA, you're only going to be able to do the max, which is for the family, and then that single $1,000 catch-up. So if you want that additional $1,000 that you're certainly entitled to because your other spouse is over 55, just have them open up their HSA, So you'll have two, and I'm not the biggest fan of having multiple accounts if you don't need it. But this is a situation where you need it to maximize that tax-deferred savings and maximizing the HSA, which I'm a huge fan of.
They're the most tax-efficient vehicle we have in the United States. Every dollar that goes in pre-tax, meaning no taxes are getting paid at all on those dollars. You can invest it. If you're young enough, you're investing it for growth. Depending upon when you think you're going to start dipping into those funds, maybe you're investing it in, more income-focused options. But the bottom line is this: we are all going to have healthcare costs in the future.
Indeed.
Full stop. So, why not at some point in the future be funding, future medical expenses with money that's not taxed as it goes in? You get tax-deferred growth while it's in there being invested. And then as long as you're taking it out for a qualified medical expense in the future, even the gains are coming out tax-free. So you're literally using money and earnings that have never paid a penny in taxes to cover qualifying health expenses. And the list is really, really long. So I'm a big fan of using HSA accounts.
Yeah, and if you have the ability to absorb costs that are out of pocket, you could use the HSA as a long-term deferred savings vehicle. I try to do that to the best of my ability. Obviously, I got two young kids. We got Turner, who's turning one, or he's turned one.
Turned?
No pun intended. But the little guy's walking like an animal. And the problem is he's not too great with his balance, so his little feet get moving. Like his upper body gets moving forward, and his little feet try to catch up with it, which means he's out of control. And he's missed some pretty big bonks on the corner of the wall, but I'm talking about like a hair, like just millimeters. I'm like, at some point we're going to run into an issue where, hopefully not, knock on wood, but I'm just waiting for it. I think that's just a part of the protocol of being a boy dad, and I'm certainly getting used to it. But all that to be said, where you have to gauge how you're managing your HSA at the household level, meaning if you feel that you need that liquidity to cover those healthcare costs out of pocket before insurance kicks in, before your deductible and things like that, then you could almost look at the bucket system that we have, meaning let the timeline of when you're going to use the money determine how you invest or if you invest that money at all. So, Nick, you nailed it. HSA, you have the ability to invest those dollars, which is great. So should you? I don't know. Do you need that liquidity in the HSA to cover healthcare costs in the immediate? Then you probably are going to do a combination of both, meaning keep enough liquidity in that HSA for those maybe you have those expected healthcare costs that are coming down the horizon, and then anything above and beyond that, well, you probably don't need in the immediate future, especially if you're still max funding it. So then you could invest that for maybe growth or more income.
Yeah, and I'll have clients that come in and be like, they'll say, well, we spent all of our HSA. We had some medical expenses this year, so we couldn't invest it. And they act as if like it was a miss. I'm like, no, that's still not a miss, because you're using money that never got taxed to cover medical expenses. That was the whole point. So you got the tax deduction and you covered your medical expenses. It's a win-win. Don't feel bad about it.
So if you're not sure if you have an HSA, find out. You have up until April 15th to make that election. When we come back, we're going to talk about 1031 exchanges and Delaware statutory trusts. Stay with us. Apollon Wealth Management has transformed the way our team delivers financial advice. With their support, we're more equipped and more empowered than ever to provide top-tier financial planning, investment management, and personalized financial guidance. Apollon has been a key partner in helping us achieve our clients' unique financial goals. Whether you're an advisor looking to enhance your client experience or an investor ready to take your wealth management to the next level, reach out today to the Real Money Pros by visiting therealmoneypros.com. Let's elevate your financial future today.
I'm Nick Daniels with Tree City Advisors of Apollon. My team and I help our clients implement tax-smart strategies because taxes are one of the largest headwinds your investments face. We use strategies like Roth conversions, 1031 exchanges, and more because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then used tax-free for all of your qualified healthcare expenses. That's why you need Lively, our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Begin your home ownership journey today. Look no further than Academy Mortgage, your first choice home loan lender. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Their team of seasoned professionals will be with you every step of the way. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
Welcome back to The Real Money Pros. TheRealMoneyPros.com is where you can find us. One of the best ways to interact with our program. We are extremely excited. We're working really hard over the past few months on revamping our website and really trying to put forward our approach when it comes to investing. Meaning it doesn't need to be complicated. It really comes down to how you effectively build a strategy, and then based on that strategy, logicking yourself into or solving for the timeline in which you need to move, the timeline in which you need your money, which then determines how you bucketize your money. That's the better bucket system, meaning let's make sure you have enough liquidity, but you're not too conservative, but we also make sure that you're not too aggressive to where if we see some significant market moves, which, hey, listen, you could look at the probabilities of the statistics and you could say that we are overdue for a healthy correction and maybe a bear market, if you will, and how you could look at maybe these things are almost needed to help filter out the speculation side of the market where there really isn't tangible value or the fundamentals don't necessarily line up with that level of valuation, otherwise known as price to earnings ratio. We heard our chief investment officer with Apollon Wealth Management, Eric Sterner, mention that in our previous hour interview that we did with him. So we certainly appreciate him calling in. But again, this better bucket system helps you solve for that. It truly does. It allows your desired outcome to be solved for, so it makes sure that your investments are aligned with that. So the reality is I got a number of retired clients where even when we saw that big market pullback during Liberation Day and the concerns around tariffs, they're fine, meaning their retirement picture was not left in the question. COVID was a prime example of that too, meaning our retired clients, even though the whole world was shut down and that was like a completely different scenario. But if you were just looking at the markets and investments on their own, they were still in good shape. They could still manage their cash flow. They could still hit their wants, their wishes, their travel, their charitable gifting, all that was in there. But it all comes down to this thought out, solved for approach per the better bucket. So again, therealmoneypros.com. That's where you can interact with us. Use the Ask the Experts feature. Use the live chat feature. If you want to call us and you want to chat with myself or Mr. Nick Daniels, 979-59-MONEY. That is 979-596-6639. You want to know about Roth conversions. You want to know about tax moves to make before the end of the year. If you're self-employed, what options are there for you? Send it our way. We'll give you some advice. Nick, I think you and I have ran into this situation more times than not, where you have someone that made a very prudent financial move, maybe 5, 10, 15 years ago, where they saw an opportunity to buy a tangible piece of real estate. They were turning that into an income-producing property. That thing was almost set on autopilot, wasn't a big thorn in the side as far as the property management side of things. They were working in conjunction with that. Maybe that investment property wasn't netting a tremendous amount of income because maybe they were still carrying a mortgage, all that. Now you fast forward the clock, maybe a decade or more, and now this thing is owned free and clear. Maybe they want to start simplifying their picture because they're entering into retirement. They don't want to manage this investment property. Maybe they don't like the liability that's tied to it of a potential tenant coming after them from a legal standpoint. And they're thinking, man, I just want to unwind this, but from where I purchased it to where the value is now, I'm going to have to pay a ton of money in taxes. I don't want to do it. What are my options?
Yeah, so this is where a 1031 exchange comes into play. And a 1031 exchange, 1031 stands for like the IRS rule that says, hey, if you have a highly appreciated piece of property and you're not willing to pay the taxes on it yet, you can do a 1031 exchange, meaning you're taking the gains on that, and instead of capturing the gains, cashing out, so to speak, you're just rolling into another piece of property. So you're kicking the tax can down the road, and so you're just going from one like transaction into another like transaction. So a piece of property into a piece of property. To be clear, though, you could go bare land into multifamily. You can go multifamily into single-family residence. It's actually pretty broad, this like for like. But let's just use real estate as an example, right? It's the most it's the one that's easiest to track with when we're painting that mental picture. You own a piece of property. Let's just say single-family housing. You can 1031 into more properties. Now,
so 1031, let's talk about those logistics real quick, meaning you have to have a qualified intermediary in the mix, meaning when you sell that investment property, your hands never touch the money.
Correct.
It goes into a qualified intermediary managed account, and then that money basically sits there until you've identified and closed on the replacement property. But that qualified intermediary, I think there's other names that you can use in that regard too, but they kind of facilitate this whole transaction to make sure you adhere to the rules of this 1031 exchange so you don't run into any tax complications.
Correct. And I believe you have, if you're going to do a 1031, I believe you have, 45 days to identify the next property that you're going to use those funds to purchase. And then I believe that purchase has to be completed within, is it 90 days?
I believe so, yeah.
So there's some rules that you've got to adhere to. Now, here's what's beautiful about 1031ing into a DST, which stands for a Delaware Statutory Trust. Now, this was created as a way to basically what I want you to think of, listener, is it's a portfolio of real estate. Okay, it could
sounds
be
like a real estate investment trust, Nick. That's essentially it.
Yeah. That's exactly what it is. But the DST was created to allow a real estate investment trust essentially to qualify for the 1031 exchange rules. So if you're tired of the tenants and you're tired of the termites, and you're tired of
floods,
the
water heater
all
having
of
a drip
things,
and insurance
yes.
won't cover it.
And you're saying, but I also don't want to pay taxes. You can do a 1031 exchange. So you can actually sell your single-family property, take the taxable gains, and do a 1031 exchange into a Delaware statutory trust. And let's just say that it goes into it's a multifamily property. So you're going into an apartment complex that is held inside of a DST. You do not have to pay those capital gains taxes yet because you 1031 into that property. Now, what are the benefits of it? Well, first and foremost, you are deferring the taxes on your long-term capital gains. That's the primary reason why you would do it. But secondary benefits. If you are accustomed to getting monthly rental income from that single-family property, guess what you're going to get with this DST via a 1031? You're still going to get monthly income off of that. However, you're no longer the landlord. You're no longer even interacting directly with the property manager. So the DST already has all of that in place. So one of the things that you need to be aware of, what's the trade-off of that? Well, your yield might be a little bit lower than what you were getting on your own property, because within that DST, right, are the fees for the maintenance and the management and all of that sort of thing in there. So we're talking about 4.5 to maybe 5.5% yield on that DST. Okay, so that's one of the trade-offs. The other thing is liquidity. All right.
So this is an important thing to bring up, Nick, because now we're kind of getting into this crossover of, okay, the 1031 in and of itself, 1031 exchange, that's that tax efficiency component of it, where you're not recognizing that taxable gain, you're deferring the gain, and then if you put it into a Delaware statutory trust, DST, essentially you're putting it into a professionally managed fund of real estate. So think of it like a real estate investment trust. This is not a publicly traded instrument. This is private. So a lot of people are getting more familiar or a little bit more interested in these alternative or private investments because they've grown in popularity as of late. But the one thing that you have to be mindful when it comes down to these non-publicly traded alternative or private investments is the trade-off, and that is liquidity. So the 1031 exchange dynamic in and of itself, undeniable to have those tax efficiencies, but where that money lands as far as the actual investment is critical. I have clients that are still stuck in real estate investment trusts from around 2010 and before that they can't get their money out of, meaning there's no way, like, you are beholden to the fund to allow for redemptions. That's it. So meaning they may offer the redemption, they may only give you a portion of your redemption request, or you could be locked up in this thing for over a decade, even more, where you're just like, okay, and then they'll give you some tender offers, which are just pennies on the dollar. Like, all that being said is when you're talking about these private alternative investments, you have to be aware of who the fund manager is, what is their track record, what is the risk, what is their ability to hit that liquidity mark. Because generally speaking, Nick, I think you could say that if you're going to put your money into a Delaware statutory trust, you got a lack of liquidity for probably about a 5 to 7 year period.
Yeah,
right?
5 to 7 year period. Now, understand though, you're still getting monthly income off of your investment. You're just not going to be able to pull out your principal for 5 to 7 years. So on these DSTs, they can be a great way to delay or defer long-term capital gains. They're a great way to continue getting monthly income. Another benefit, though, is you still receive a step up in basis. So if you're married and you had a single-family property and you sold it, did a 1031 into multifamily DST, and one of you passes away, the spouse gets the benefit of a step up in basis on that DST, which makes your tax situation very, very favorable. So they can be a really, really good tool if taxes are a headwind on highly appreciated property.
Swap until you drop, as they say, to maximize that step up in basis. We got to take a break. This is the Real Money Pros. Stay with us.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs, from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Have you ever met with a financial advisor looking for some advice just to leave being sold an annuity you didn't want? At Tree City Advisors of Apollon, we do things a bit differently. We focus on your financial goals, helping you fix past mistakes, simplify your current finances, and plan for the future with confidence. Your first consultation is always free and without obligation. Visit TreeCityAdvisors.com and start your journey to financial freedom now. That's TreeCityAdvisors.com.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
And we're back to the Real Money Pros.
Welcome back to the Real Money Pros, therealmoneypros.com. That's where you can find us, interact with us, use the chat feature when we are live, use the chat feature during the week, use the Ask the Experts feature. If you want to send us a message, you will get a response from one of the fiduciary advisors on our team. We're coming up to the end of the hour, but hey, we're here every weekend running a 2-hour program live. So if you want to fit a phone call in before we say adios for today, call us, 979-59-MONEY, 979-596-6639. Certainly excited about where we're heading with the Real Money Pros as far as the website, the imaging, the reach that we're doing through social media. It's good stuff, and we appreciate the opportunity to provide this educational content. We're not here to sell you anything. We are fiduciary advisors during the week when we're practicing Monday through Friday, and we are fiduciary advisors here when we are broadcasting on the airwaves. So, again, interact with us. We had a great question coming through our website chat. This is coming from Doug, and Doug asks, if you have a health savings account for only 9 months out of the year, does that mean you can only deposit basically 9 months worth of the yearly amount? Great question. And the answer is yes, with a little asterisk next to it, okay? So basically speaking, that you take your total amount that you're eligible to contribute to an HSA, take that amount, divide it by the number of months that you're eligible, and that basically arrives at the amount you're eligible. So let's say that you're only eligible 9 months out of the year. That pro-rata calculation essentially says that you could put in, out of that total limit, $8,300, you could do the total of $6,225. But there's a little caveat, a little carve-out to this, and this is what's known as the last month rule. So if you are HSA eligible, let's just say in calendar year 2025, on December 1st, you are allowed to contribute the full annual amount, even if you were only eligible for part of the year, right? So let's imagine you became eligible for an HSA plan, let's say in April, even October this year, whatever. As long as that HSA plan is still rocking and rolling of December 1st of this year, you can do the full amount only if you are HSA eligible for the entire next calendar year. So to answer this question directly, if for 2025, if I was only eligible for an HSA, let's say 9 months out of the year, does that reduce the amount I'm eligible to contribute? Yes, but if you are going to have an HSA plan going into 2026 and your HSA plan for this year, you were eligible, and for December, you can do the full amount. No problem.
Yeah, so I think a really important question, let's say that you have an HSA coverage through your employer-sponsored health plan. It'd be really good to talk with HR and say, hey, you're not planning on making any changes to our plan in 2026, are you? Because I really want to be covered by an HSA every single month of 2026 so that I can max out my HSA for 2025.
Yeah, and it's one thing I want to mention too is that if you have an HSA, again, health savings account, not to be confused with a FSA. This is a health savings account, meaning if you do not use the money, you keep it, you don't lose it, right? So this is different from a flexible spending account, FSA. We're talking about HSAs. If your employer is doing any type of match or any type of contributions on your behalf as an employer benefit, meaning, hey, us as a company, we're going to take company dollars and we're going to put that into your HSA as a benefit to you, that amount that they put in reduces the amount that you're eligible to put in. So just keep that in mind if you're looking at, hey, I want to max this thing out. If your employer's dumping money in there, just reduce that amount a little bit. The nice thing is, again, that you have up until April 15th of the next calendar year to maximize that HSA contribution. So if you look at your employer plan, you're like, man, I missed max funding it by about $2,000. Not a problem. You can still do an external contribution that does not have to come through payroll to hit that max into an HSA. It's a really good question. One thing that you got to pay attention to is if you're coming up on age 65. So let's imagine that you turn 65 in calendar year 2025, let's say in July or June, then that's where you have to definitely do that prorated HSA amount, because once you hit 65, you're no longer eligible to put money into that health savings account. Something to pay attention to. Another thing, since we're talking about income limits and we're talking about things to pay attention to the end of the year, this is something that's been brought up, and it's a bit of a miss that I've seen with prospective clients that either they weren't paying close attention to, or whoever they were getting their advice from wasn't paying close attention to, is if you want to put money inside of a Roth IRA, you have to understand where your modified adjusted gross income is going to be for the year. Because I've seen a lot of people where they just kind of do a small amount every month to max fund their Roth IRA. And then when it's all said and done, filing their tax return, turns out that they made too much money to make those contributions in the first place. So it's not overly complicated to unwind, but you still have to take these next tactical steps to unwind that Roth contribution. Pay attention to that, because if you're used to making those Roth contributions on an annual basis, even after the tax year is done, make sure you know where your income's going to fall, so you're not disallowed from that Roth contribution.
Yeah, and if that happens to be the case, I've got a situation where we're working on that right now. Like, you can get those recharacterized. Every custodian's going to have a link to the paperwork that you need to file, and there will be a formula that you need to calculate based on like your entry points. If you were buying, say, an exchange-traded fund or an individual stock, you're going to have to track any gains in there and get everything recharacterized so that it's correct. It's just a little bit of a paperwork hassle. It's not moving mountains to get all of those Roth contributions recharacterized as pre-tax traditional IRA contributions. It's just a little bit of work, but it can be done.
It can be done. But pay attention to it. I mean, a lot of these things that we're talking about, the income thresholds, which allow you to do something or disallow you to do something, most of the times these are based on what's called your modified adjusted gross income, your MAGI, which is a little different than your adjusted gross income, because your modified adjusted gross income has some certain items that are added back in that could increase that amount or maybe lower it. So pay attention to it. You know, as we're going up to the end of the year, like if you were just to call in and say, hey, here you guys, you know, you're talking about HSAs, you're talking about payroll deferrals for 401ks, you're talking about these types of items. What else? Like, what questions should we be asking, or what conversations are you having with your clients that you need to pay attention to before the end of the year? I mean, we can paint with some broad brushstrokes, but certainly tax loss harvesting is one of those. Let's imagine that you've been a crypto investor, maybe in some of these ETFs, and you're starting to see some losses on paper. Take advantage of it, meaning sell that. Again, this is only if it's in a non-qualified account, meaning it's not held in a Roth, it's not held in a retirement account, it's not held in one of these tax-deferred accounts, meaning it's held in your name, joint name with you and your spouse or another individual. Maybe it's held in the name of your revocable living trust. If you see some losses on that capital gains report or that unrealized gain loss report, based on this market activity, you might see some losers on paper where you can effectively sell that position, book that capital loss that you can use to offset up to $3,000 of income for that year, assuming the loss is that high, or you can use it to offset some capital gains that's maybe inside of your investment account, or maybe you sold some real estate, or maybe you have a business venture that you're receiving some K1s on that can help offset that. So it's just tax-efficient management through tax loss harvesting, meaning don't look at the losses as paper as like, dang it, I made a mistake. If you're doing the proper diversification approach, you're probably going to have some winners. You're probably going to have some positions that are flat, and you might have some losers. This is kind of my experience in a year-over-year basis. Take advantage of it. Utilize that tax loss harvesting. Be cognizant of the wash sale rule. If you sell a position at a loss, but you want to purchase it back, you got to wait 30 days to avoid that wash sale rule. But something that I would certainly pay attention to as we head into the end of the year.
Yeah, absolutely. One thing I like when it comes to avoiding that wash sale rule is a lot of times, like if you're selling an exchange traded fund or a mutual fund, sometimes you can actually just get a different fund from a different fund manager.
Yeah.
So you can get the same exposure that you had, but you're not worried about the wash sale rule.
Yeah.
Hard to do with an individual stock. You got to wait the 30 days. But on exchange traded funds or mutual funds, you can maintain that exposure, but do your tax loss harvesting.
Tax loss harvesting, Roth conversions. Listen, if you want to move forward with a Roth conversion, make sure you're planning for that in this calendar year. If you get in the calendar year 2026 and you talk about, hey, I want to convert some money to Roth, and you're looking at your 2025 numbers, too late. Now is the time to look at your income. This is a great time to be tax efficient, effectively recognize income by moving money from a pre-tax IRA to a Roth. If you have questions, send it our way. I'm Jeremiah Bates. He is Nick Daniels. We'll be here next weekend.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational materials,